Welcome to the Daily Update. This is Being Prepared Thursday, April 14th, where we'll discuss the action in the market today and then see how things look for Monday, April 18th. Please remember that Friday, April 15th, the stock market is closed in observance of Good Friday, and trading will resume on Monday. So, how did things go on Thursday? Not all that great. It looked like the scenario that I had been kind of looking at, where the little bounce that we got on Wednesday, that really was just enough to wear off a short-term oversold condition. And then we resumed going down as the market opened on Thursday. And so things are still pretty negative across the board. We're back to being short-term oversold again. So if we get some kind of a bounce, it may be to wear that off. There are still the potential positive backdrops that I've been discussing from time to time, but we can't really focus on those until we see an improvement in our technical picture. And right now it's pretty weak. Things are just not going very well. But when we see an across the board negativity, that usually signals some kind of a bottom, but we're not seeing that. We haven't really hit any major support price-wise. And on a sentiment level, we are showing a little bit more fear right now, but not very much more. So people are fearful, yes, but not extremely fearful, like they were back in the middle of March when we saw that really nice bounce. It's not all coming together yet. So that could still suggest that there's more downside. Now, anything can happen. And if we do get some kind of a short-term bounce on Monday, and that has some across the board strength, maybe some things come into the market that helps sentiment become a little more positive, that could drive prices higher. But we've been looking for that now for a while, and it just really hasn't been happening. But beware, this is a 3-day weekend. Even though it's a religious weekend, there can be some political elements to it going on in different places in the world, specifically within Israel. You've got Ramadan occurring. You have, of course, the Holy Week for Christians. You also have Passover for the Jews, and sometimes that can create some problems. Sometimes there's no problems at all. So, but it's one of those things where it can be very emotionally charged at times. So let's go back and look at how things happened on Thursday. We did have kind of a flat open. We had the release of retail sales that came out, and the market kind of, and the futures had been pretty much unchanged during the night as I was following them. But then right after the market opened, we saw some pretty fast selling immediately. And that took us down below the daily pivot level. And I've tried to label those on the intraday chart. So hopefully that will help a little bit. Then as the day went on, we saw a slight bounce that took us back to the daily pivot. So what had been acting as support, since we blew through that, as we were coming back up, now that acted as resistance. And then selling came back in again, took us down to S1, and then we bounced back to the pivot. So yeah, and this is what you see in more of a sideways choppy market. You don't see, well, we saw some more trending later on in the day, but you see a lot of bouncing around. Then as we got closer to the close, selling did resume, and that actually took us below S1 into the close. So we saw selling, a little bit of buying, and then selling. We ended up closing at the low for the day, and we ended up being down 1.21%. There was an increase in volume, but it's still below average. And this was probably some folks just closing out some positions before a long weekend, and just the whole uncertainty of everything that's going on right now. The shorter term traders probably just wanted to get rid of some things in case something does blow up over the weekend so that they're not caught on the wrong side. Then the technicals right now are pretty much negative across the board. And so, and I'll go through the charts and show that. The big scenario, or the big focal point right now that is engulfing the market, is inflation and interest rates. Interest rates did go up on Thursday, and that drove especially growth stocks down. And then all the geopolitical concerns, and I'll kind of go through those again, but they're the same ones that I've been talking about. So what are some comments we can make? The technicals are negative. We got below the 50-day simple moving average, as well as the 200-day exponential moving average. So we regained those on Wednesday, only to lose them again on Thursday. So there's a real bouncing around that's going on, a lot of indecisiveness. We are short-term oversold again, and this is the big focal point. Rising interest rates, when they go up, that has a real impact on growth stocks. And we'll have to see if we see a decline in interest rates, will that help growth stocks to actually increase in value? The yield curves are no longer inverted. And if it stays this way for a while longer, I'll probably stop talking about that, because now we're just waiting to see, will we get that positive blast up that we've seen sometimes before after the yield curve reinverts or goes back to being more normal. Another thing that probably also helped stocks decline a little bit on Thursday was that the dollar index was back up, and it ended up closing above 100. And that just shows a stronger dollar. And sometimes that can have a negative impact on stocks. There's a lot of Twitter talk now. That's the financial. I don't watch the financial media, so I can just kind of guess, but I see enough headlines. I watch a few videos here and there on YouTube or Rumble. And so it just doesn't seem to meet a need of mine. I can see what I want to see by just looking at the charts, but there's a lot of Twitter talk now because Elon Musk came in and said, well, I'm not just going to own 9 or 10% of the company. I'm willing to buy the whole thing. And now there's the debate going back and forth. You have the people that say that there should be more moderation on social media. That's the true definition of democracy. And then you have more of the things that Elon Musk has said, well, I think this should be a platform where people can share whatever they want. It may be silly and you may not agree with it, but they should at least be allowed to say it. And that's kind of the back and forth. And then I just saw something where I guess Vanguard came in and bought more shares, and so they actually are the largest shareholder now in Twitter, and they might try to stop this whole thing. It's back and forth. You don't know what's true, what's not true, but it's interesting. It doesn't really impact the S&P 500, even though Twitter is part of the index. But it's just kind of interesting to see how this whole thing plays out. And it just kind of echoes what we see going on more in specifically American culture, where what is freedom of speech? What should people be allowed to say, and what things should they not be allowed to say, or should that be regulated at all? And that's kind of the underlying current that seems to be going on right here. We did have retail sales that came out on Thursday, and they actually declined. So the retail sector, or people buying things, makes up a huge part of the US economy. And if that's going down, then that just shows that there could be an economic slowdown. Now, at the same time, and I don't know why they do this, if you take out autos, then retail sales actually advanced. But it's one of the, but everybody, I know not everybody has to have a car, but they're such a big part of American culture and the American economy. Whether you might not even own a car, but yet you work for a car factory, either directly or indirectly. So it's a huge part. Now, I understand, because they say the prices are so volatile and it doesn't give you a real indication of what's happening, but it's a part of real life. So anyway, one thing that was a little bit surprising is consumer sentiment actually improved a little bit. And I'll have a chart that shows that coming up here. And people are maybe hoping, they're a little more optimistic in the future, thinking that maybe inflation will slow down, maybe gas prices will actually fall a little bit. So they seem a little more optimistic looking out. And they're not necessarily happy right now, but they're hoping that things do get better. As far as our ADX and the trend, we are still trendless. We're under 20. We're going sideways with the ADX. And that kind of shows the choppiness that we saw on Thursday. Because we had a down day and we've had a number of down days, the bias is still negative as well as the momentum. So let's go back through, look at the day's session sentiment. This is the University of Michigan's consumer sentiment. Now, this is the preliminary reading. They'll come out, and I think in 2 weeks, with the final reading, where we have the 2-year treasury yield in red, and that's just been shooting up. We've been watching that on some other charts, and we have seen where consumer sentiment has really been declining. Well, we saw a bounce. It's up to 65.70 or so. I think that's what that number is. It's a little hard to read. It just shows that people are a little more optimistic. So we saw a little bit of a decrease between the spread. Because again, as I point out, every time we have this report in a really good, strong, healthy environment, it's okay to have interest rates going up like they did from 2012, 2013, all the way up until 2018 or so, and even into 2019. That's okay. It's all right if interest rates are going up as long as people overall are feeling better. And they chop around. They're bipolar. I mean, we're crazy emotional creatures. So sometimes that can happen. But that just shows more of a positive backdrop. What we've been seeing lately is interest rates are going up and sentiment is going down. And this doesn't really change anything right now. It's just, what are we going to see from here? Are people going to start to feel better, or are interest rates going to come back down to make this more of a friendly environment where people just feel better about things and it's okay that interest rates are still rising? Then our fear and greed index, it fell. We're kind of right on the edge of now going into fear territory, but not any kind of an extreme reading at all. This is really more towards the neutral side. When we start dropping below 40, that's when it becomes more fearful. So, but we are showing a little bit with the decline. And then here's just the chart to give you some historical perspective. Yeah, if we drop below 40, that's when I kind of take it a little more serious. And if we go below 40 and keep declining, that usually means the market is headed lower. The VIX spiked up just a little bit, but not as much as you might think. And on the closing basis, it went up. And then on the bar chart, it also closed right at the high for the day, because we closed at the low for the S&P 500. And then here's the VIX of the VIX, also showing a little bit of a tick up on a closing basis, and the bar also advanced a little bit. But the VIX is not really all that crazy right now. If we were going to get near a bottom, we probably want to see it higher than where we're at right now. Now, it doesn't mean we have to go real spiky. You can see other times back here where we hit a low, where the VIX was kind of near where we're at right now, but we're just not seeing the fear that we see when a solid bottom comes into the market. Okay, let me switch over here. The ulcer index continues to advance because we had another down day, so we want to keep an eye on this as well. And then we did have the weekly American Association of Individual Investors. They came out with their survey and they're very negative again. And I actually tried to highlight that and put a little arrow where they're now extreme negative. Now that could be positive, but this is about the only place I'm seeing this right now, that anybody is showing any extreme pessimism currently. But we'll just, because this could still go lower. I mean, if we do go lower and fear finally catches some fire and sends prices lower, you can see other times we've gone lower than this, but this is also an extreme negative reading. And then, but we're not seeing it in the next one. This is the RIDEX bearish to bullish ratio. It just shows that, yeah, bearishness picked up a little bit, but it didn't really spike like what we saw in the March low back here. This could go a lot higher before we hit any kind of an extreme reading. And then we had our active money manager survey. Since we had a down week and since our momentum's been negative, they've been taking off a lot of their riskier investments. They tend to react to what's happening too, but we're not really at an extreme reading at this point. Different sectors. Just had two sectors that were up. 9 out of the 11 were down, with tech leading the way lower, communications, the usual suspects lately, discretionary. These are the three weakest sectors, and so they were down the biggest. The financial sector's actually been having a bit of trouble lately as well. The two sectors that were up, utilities and energy, which have been the stronger sectors so far for 2022. And this is just a representation here. Energy, utilities, staples were up a bit. Then at the last, now we have tech in last place, with communication, and then discretionary also showing weakness. Then just to look at our tech sector chart, we were down 2.43%. We're still below the moving average, and the rolling average is starting to roll over. Then looking at our SOX index, the semiconductors, they were down 2.77%. So this growth stocks really got hit pretty hard on Thursday. Inflation with our CRB, it was up 1.21%. So that kind of feeds more into the inflation fears that people are seeing. Then the CRB continues to greatly outperform the S&P. Here's the inverse showing how the S&P is underperforming commodities. Technical alerts, the euro set a new 52-week low. The dollar set another 52-week high. NASDAQ went below 13.6, 13.5, 13.4. And the euro also ended up setting a 2-year low. That's kind of interesting. The S&P was below 4,400. We did close below that. Oil was back up over 105, and the dollar, let's see, 52-week high, and also closed above 100, and I'll have a chart of that. So let's look at the day. It was kind of a flat open. We gyrated around a little bit like we always do. And see, I tried to put some labels on here because sometimes I forget what these lines are. Once the day is done, these labels go away, and sometimes I mix that up a little bit. But right after the open, after the first 10 minutes, because each one of these bars is 10 minutes, we saw pretty significant selling, took us down below the pivot. Well, we kind of tried to inch our way back up to the pivot, but we were not able to significantly break through that. That took us down to S1, and then we bounced back up to the pivot again, only to bounce back down to S1, and then ultimately see a little more selling going into the close, and we went below S1 for the day. So that's choppy, but pretty negative overall. Then here's the daily chart, back below this pivot level right here. And as I keep pointing out, unless we can hit some kind of other short-term support level, there's a lot of open real estate below where we're at right now. Oh, and just to show you also where volume did increase, but we're still below average. Right now, we're down 8.42%. If we get to that 10% level, that's where we are in correction territory, but we're not there yet. Growth saw a decline, value saw an advance. And here's the ratio between the two, showing how growth is really underperforming currently and how value is outperforming. Then the NASDAQ 100 underperformed the S&P 500. And then here's our peer value index. It was actually up 0.08%, where our growth was down over 2%. So that just kind of shows again that growth really saw some weakness on Thursday. And then here's the ratio between the two, which just shows how growth has really been underperforming value. And then this is the ETFs right here. These are supposed to be the same thing. This is an index that I'm showing on this chart, an S&P index, where these are ETFs that you can actually trade. I don't plot the volume on the bottom because when you do a ratio, the volume can get kind of weird looking. As far as our trend, the ADX is going flat to slightly lower. So that shows that we are in a non-trending environment. It was interesting to see how the red line actually declined on Thursday on a down day, but the green line is also declining as well. So we continue to be in a non-trending environment, but we default to the negative trend because the red line, even though it's declining, is still on top. The Arun, it's not really picking up too much. A decrease in selling, decrease in buying, also a decrease in selling, and we were flat from Wednesday to Thursday's session. A little bit of change on the decision point scoreboard. Their trend model is now neutral, short term. They switched over to negative earlier in the week. And what was it? I thought another one of these changed, but I guess no, they haven't changed because it was at the end of the month, end of March, when the intermediate term signal switched back to positive. Breadth, not looking very good right now, seeing a decline based on price as well as volume. Advanced decline ratios kind of hovering right around the midpoint right now. New highs, new lows continues to trend lower, showing some internal weakness. The accumulation distribution is just starting to come under the moving average now. It had been holding up, but it's starting to show some of the overall weakness that we're seeing. We are below the 20 period moving averages. The 20 period moving average did see a decline inside the S&P, as well as the 50 and 200 moving averages also saw declines. We're at the bottom of our spaghetti tree here, so we broke back through. The last hangout for moving averages that I plot was the 200-day exponential, and we've now closed below that. MACD in a downtrend. Short-term trading oscillator turned down based on price, but went up slightly based on volume. So a little bit of a difference there. McClellan oscillator continues to be negative because it's below zero. Now, this is where we're getting into some of the short-term oversold indications. The Stoke RSI continues to be pegged negative. Williams percent are in extreme negative territory. Force index, not really giving us an extreme reading, but is still showing more weakness. Intermediate term, we are below the 50 period moving average. And with the red one being the one that a lot of people focus on. So we were able to get above that on Wednesday, only to come back down below it on Thursday. And the exponential moving average could be acting as resistance. PMO, negative, also based on price and volume. PMO study shows a decline in those PMOs that are actually rising, a decline in buy signals, and just a slight decline based on those that are above zero. The BPI, again, this kind of held up a little better. It was down, but we're not seeing these huge bars being drawn right now. But we are seeing a decline overall, and here's the longer term chart. We're at the bottom of the rainbow now, and things are really starting to collapse as all of these lines come together. This is another part of our short-term oversold condition. The shortest stochastic bounced up. We wore that off. Well, we're right back down here. We saw a little bit of an upturn with the intermediate stochastics, but they are still extreme negative, where the full stochastics are still trending lower. The summation index declining based on price and based on volume. All of our momentum oscillators have now crossed over negative. The CCI based on 14 periods, it's extreme negative, trying to bounce up out of that, but has not crossed back over positive yet. That's part of the short-term oversold condition. And then our little longer CCI, it's going into extreme negative territory. The vortex, saw an increase in selling and a decrease in buying. The RSI below 50 and declining with the 14-period RSI, below 50 and declining with the 9-period RSI. Elder system based on the S&P back to a red bar, so that is negative, with a declining MACD below 0. Also the spiders back to a red bar. SAR continues to be negative with the dots on top. Our different charts, Hike and Ashy, still looking negative. A lot of dark filled in candles. Kegi, negative. Renko, negative. 3-line break, negative. Equivolume, a lot of red candles right now. The ease of movement on 14 periods is below 0 and declining. No change with our point and figure. The last signal was generated yesterday with the high pole warning. This is the pole right here. And then to drop from there, that's picking up a negative signal, but no new signals were generated after Thursday's session. Long term, we are below the moving average, the 200-day moving average. And these charts are identical. It's just how they're plotted. Sometimes I like using both. This is just based on arithmetic. These are numbers. But then if you look at the logarithmic, the numbers get kind of scrunched up, but you can see the movement a little better. So I kind of switch back and forth with what kind of scale I like to use. The big honking tech stocks, they got hammered. They were down over 2% and are well below both moving averages that are plotted here. The special K, it's really starting to roll over. And so that's also pointing to a longer term downtrend. Then our moving average study based on 50, a decline, based on 150, it's kind of flat to a little bit of a decline, and more of a decline with the 200-day moving average. We're dropping below the 38.2% retracement level with the S&P 500. Then some other markets to look at. We're just kind of bouncing along. This is a sideways choppy market right now, but the mid caps, even though they tried to break out a little bit, are also going sideways. Small caps also tried to break out, but are kind of forming. And we don't even know, is this a base or it's without sentiment being really negative right now, it's kind of hard to make that case. Now, one thing that you could see developing on any one of these charts is a potential head and shoulders bottom. We have like an inverse, okay, more like a W with a long dip in the middle. Here could be a shoulder over here. We dropped a little bit lower, coming back up. Now we're coming back down. Could that be what's happening? That would be more positive, because where a head and shoulders top, that's negative when you're at the top. A head and shoulders bottom is kind of when you're standing on your head. That could be more positive once we get done trying to get through this. That could be what's happening. We have to watch this being drawn out. It's not as prevalent with the mid caps and the small caps because they've been going more sideways overall. Then the Dow Jones Composite right on the moving averages, with the moving averages almost kissing each other. Then transport saw a little bit of a bounce in the trannies when we look at Dow theory, but we're seeing a lot of really declines, even though the Dow's been holding up fairly well. It hasn't been gyrating all over like the rest of the market. And then the utilities, of course, have been performing very well and had a bounce up on Thursday. The FANG stocks just got hammered down over 3% again. And we're seeing a series of lower highs and lower lows. ARC got taken out and shot again. It was down 4.44%. And the Dow, this is what I'm talking about. We're just kind of treading water sideways. We're still above the pivot. We're still above the 50-period moving average, but we did close at the low and we're below the 200-day. And here's our diamonds. They've switched back to negative. Small caps, below the pivot, below both moving averages, but kind of in a tighter range right now. Mid caps, kind of the same thing. Back below the pivot, that actually acted as resistance, back below both moving averages right now. NASDAQ also kind of chopping sideways currently below the pivot and below both moving averages. NASDAQ 100, same thing, below the pivot. It's a broken record. I could just record this once and then loop it through, it seems. The Vixen did show an advance, then we closed at the high overall based on the NASDAQ 100. The Qs are back to negative with a red bar. Then this is a little more positive. This is the NYSE, a broader measure of the market where we're still above the 50, we're still above the pivot. We're below the 200, which is negative, but it seems to be holding up a little better. S&P 100 is continuing to underperform the S&P 500. Wilshire also right here on the pivot. Yeah, below the moving averages. So that's negative, but this could provide some kind of support. Then internationally, China's kind of off doing their own thing now, but these other international markets, we're seeing things roll over right now based on the KST. And then our all stocks below the moving average down over 1%. Just not a real healthy picture right now. And then the non-US stocks, they were actually up a little bit, 0.06%, not very much, but they were positive overall. Looking at some other measures, here's where the dollar was able to get back above 100 on Thursday. And here's now the weekly chart for the dollar. And so that's, if you, like I was talking about in yesterday's video, if a stronger dollar works to your advantage, you like that. If you're a company or if the exchange rate is not very favorable to you, that could be more negative. Oil got back above 100 again and is at 106.95. Gold up 0.5% on the futures contract and was actually down 1/3% based on the ETF. And here's the longer term gold ETF. Silver is actually down almost 0.5%. Just schizophrenia, it seems like here. Longer term ETF chart. Bitcoin's been hanging right around the 40 level. It drops a little bit below 40, then goes a little bit above 40, but we're kind of right at 40 currently. As far as bonds, and again, I'm probably going to stop showing this chart. I look at it every day, but I don't want to talk about it all the time. But this just shows that all of our different yield curves are no longer inverted. And I've tried to do some things to fix this bottom where it measures the 10-year to the Fed funds rate. Well, the Fed funds rate doesn't update all that much. And so there's some other overnight lending rates and things that I'm looking at to kind of give us more of an up-to-date, because this bottom one just doesn't change very much. Based on the other things that I'm looking at, this is still advancing. Okay, and then we have now are starting to break above the 61.8 retracement level with the 30-year yield. My gosh, we're 2.92%. And then just seeing a real advance overall in yields in the US, and things are starting to widen out slightly. Okay, where's the international? Also seeing a real increase in interest rates, but the US is still in the lead right now. Bonds showed about a 0.5% decline based on price, and we're breaking below this support level. And the corporate bond index also showed a decline where the corporate yield is now 3.77%. Junk bonds declined a little bit, and they tend to follow the stock market because their junk bonds are more of a risk on type of an investment. And I'm doing some studies and trying to analyze some things that I might show in the weekly video. And then this just shows the effective rate right now for junk bonds. We're at 6.35%. So you can't even get to inflation by taking on a lot of risk. I mean, inflation now officially is 8.5%. If you get into one of these junk bonds, yeah, you're getting 6.35%, but you're still losing overall in a riskier type of an investment. Relative, is gold starting to break out again? Yes, it is beginning to outperform the S&P once more. Energy, which had been outperforming, is still showing a pretty solid breakout compared to the S&P. Here's energy against tech, which just shows that energy has been doing much better than tech. And then here's growth against bonds. Neither one of these are doing very well. As I keep pointing out, that's why we see this little these jagged lines going on, but they're still above the moving average. So that gives the slight edge to growth right now. And then here's the tech against the S&P, which just shows how tech has been underperforming the rest of the S&P 500. Here is tech against the 10-year yield. Again, and I have that chart that just shows interest rates go up, tech goes down. In fact, here it is. And we're getting as close to -1 as we can get. You never get to a perfect score here, but it just shows that as interest rates are going up, tech is going down, and they almost have a really solid inverse relationship with each other. Then here's the 10-year yield compared to tech, which just shows how interest rates are really shooting up higher in relation to tech. Then discretionary was weaker against staples on Thursday, and the S&P has really been underperforming as interest rates are going up. Here's our low volatility. It was down less. It was down to 0.23% on Thursday, and the lower volatile stocks have been outperforming the growth stocks, which here's the ratio between that and the SPY, between the low volatility stocks. And that's kind of the place to be right now. But if you're trying to switch around and follow some of this and do some asset allocation, you're probably getting a little confused, because there are days when this whole scenario seems to switch sides. So it can be a real difficult market. One thing that we're watching for is the staples are on the bottom and they're breaking out, and they went a bit higher. Is this some kind of a spike? Hasn't even turned down yet. So we don't really know what's going to happen here. This is just something to keep an eye on for right now. And you can see when we spiked at previous times, this can signal some kind of a bottom, either short term or longer term, but we don't really know this is a spike at the time. So what's our outlook for Monday? The technicals are negative, but as you saw, a lot of them are oversold again. We're still in that trendless intermediate term range that we've been in for pretty much 2022. The battle goes back and forth between growth and value. Interest rates are the big focus right now. And then in China, I understand that they're trying to lessen some of the lockdowns, but I'm also hearing some real kind of scary things coming out of China, especially in Shanghai, where there's just some real problems right now. And what's that going to do to their economy? And then what's that going to do to the US economy, because we buy so many things from China? On Monday is the NAHB Housing Market Index, not a major mover, just something that we keep an eye on. Russia, Ukraine, yes, that's still going on. But again, from a stock market perspective, we're not really hearing much right now. And I just talked about China and the supply chain, inflation, interest rates. That's the real focal point currently. So what are our scenarios? What's going to keep us going down from here? Rising interest rates, as well as an increase in inflation fears, or I should say a continuation in inflation fears. And our technicals are negative. Yeah, they might be oversold in a short-term basis, but they're pretty much negative across the board now. What could we look at for the market to go up? We do have that positive backdrop after we see the yield curve re-invert or go back to normal. That can happen. That's still on the table, but until we see some technical follow through, we can't really latch on to that yet. At least I don't. I want to see more confirmation first. We are oversold in the short term with our moving averages and some pivot levels. If we're going down, they may provide support. If we're going up, they may provide some resistance. The current environment that we're in is scenario number 3 with the ADX below 20 and continuing to decline, or at best go sideways, where we're seeing a lot of a slowdown in price movement. We're seeing, 1%, under a percent. We're not seeing the 2-3% moves right now. Now, if we start to see those, then the ADX is going to gyrate and come back to life. But we're seeing some real choppy action right now. So what's our conclusion? The S&P is negative currently, short term negative, but oversold. Intermediate term negative, because our oscillators are pretty much across the board negative now. I should have actually taken out weakening, but they're just showing more negativity actually. We closed below the 50 and 200 moving averages. Our longer term trend, we are negative because we remain below the 200-day simple moving average. Again, here's the list. My goal is I'll prepare the daily snapshot video and then I'll do the weekly video. Because of the holiday weekend, I won't be doing any of the monthly videos right now. So thank you. I want to wish everybody a very happy Easter and have a nice 3-day weekend if you have that available to you. And I'll record the weekly video probably on Friday and then post that over the weekend. And then I'll prepare the next daily video after Monday's session.